Welcome, everyone. This is our webinar about tax incentives for innovation in Belgium and the Netherlands. Two small countries, two countries with an intricate history together, so different but so alike. Lots of cross-border business, but two separate tax systems with their own incentives, which we aim to visualize today. With me are Peter, my colleague here in The Hague, the Netherlands.
Thanks, boss.
Welcome, Peter. And we have Tuerlinckx in Belgium.
I'm Jan Tuerlinckx. Pleasure meeting you. Thanks, Bas, for hosting this event. And together with me, Jan from Hemelen. So on the Belgian side, it's quite easy. It's all Jan.
Jan and Seppa, I believe, maybe behind the scenes,
Yes.
moderating or maybe not. Jan and Jan, thank you very much. We will do a little show about what we are actually talking about here. Belgium and the Netherlands. Who is who? Now, we mean to offend no one, but we also have no pretense about how well known Belgium and the Netherlands may be. So let's highlight. Over there, up top, the northern thing is the Netherlands, population of 17.6 million and a GDP per capita of about $60,000. Then we have Belgium down south, bit smaller, 11.5 million inhabitants with a GDP per capita of about $45,000. And together, they form 2/3 of what's called the Benelux region, which was actually quite formative in the European Union. Belgium, part of Belgium used to be part of the former Netherlands, so there's history there, and the northern part of Belgium and the Netherlands speak the same language. Now, if we zoom in economically, maybe some things we can see here. Both the Netherlands and Belgium rank quite highly in GDP per capita, 12th for the Netherlands and 16th for Belgium respectively, and the Human Development Index is also quite high, 8th and 17th. What we notice also ranks quite high is what are labor costs. If we look at Belgium, actually the highest labor costs in the world, and the Netherlands following shortly after at 7th place. So one thing is clear, if you're looking for cost-efficient manufacturing, perhaps Belgium and the Netherlands would not be the logical places to go. I think I speak for both of us when I say our economy runs for 75% approximately on services. And I guess it's logical because also if we look at the natural resources available, neither of us rank quite highly. So what have we got? Low natural resources, high wages. What can we do to facilitate economic growth? Well, fortunately, we rank quite highly in the education index. So if we look here, Belgium is actually ranked second highest in the expected years of school. Now, quantity does not necessarily equal quality, but I can say as a loyal viewer of the great spelling bee of the Dutch language, which is always won by a Flemish Belgian individual, I can say that the quality is high as well. And then the Netherlands ranks 9th on that list, also with high expected years of school. So if we look at this, high wages, low resources, but high education and human development, how can we leverage that for economic growth? Well, and this is exactly what we are going to be discussing today. It is innovation. We have specific goals set in a OECD and European Union context. We want at least 2% of GDP to be spent on research and development and innovation. Belgium is actually making that quite comfortably with a 25% margin, going on 2.5% of spending, GDP earnings being spent on R&D, and we are trailing a little bit, but getting better. So innovation is key. And the reason I set this scene is because when we are talking about tax innovations, people can sometimes be a little bit skeptical. In 2021, can you still give corporate tax breaks, for instance, for innovation? And the answer is yes. You can. It's a policy goal. What is tax? Tax is using, well, financial means to realize policy goals. And one of the policy goals of both Belgium and the Netherlands is to be facilitating the brain economy. We want to generate IP. We want to make sure that our domestic brains can be utilized in an international context. And any incentive you can give attributes to what we call, well, the kind of work that we want. So let's zoom in on innovation. When we look at innovation, we can do that at two levels, but at both levels, there's a common theme. If you look at a product funding cycle within a larger firm, or if you look at a single product firm, also known as a startup, there's a definite pattern that that recurs. In the beginning, there is only development. There is not a minimum viable product yet, so nothing is being sold, and that basically means that you are only making costs. So if we look at the orange line, we can see that in the beginning, you need a cash investment because you have costs off the get-go, your R&D department and your lab, or perhaps you're not innovating in a laboratory context. That's totally fine as well. But both these components require funding. So in the beginning, a innovative product or firm needs to be financed. Now, of course, tax facilities there can cut costs. So if you can find incentives that, for instance, give you discounts on your R&D department, then you can reduce your burn rate, lengthen your runway, or reduce your cash need. Then some point later, you start running into minimum viable product and you're going to do sales. So that is where we see the orange line growing. You have passed the break-even point and you start becoming profitable. And in the profit phase is where your investors get paid back. So basically, the more attractive your profit regimes are, the more attractive your investment proposition will be towards investors who you need, because in the beginning, you do not make any revenues. So if we look at what does tax incentives for innovation mean, basically, we find two phases in there. We have the cost phase, where you look at incentives that help you reduce cost. And then we have the profit phase that look at incentives to help you maximize output, free cash flows, shareholder revenue. Then there is a question, what exactly is innovation? Now, this is a much talked about topic. So I found a fun little interview. It's 2 minutes long that took place at the OECD's Economic Forum almost a decade ago, but it's valuable still today. So with your permission, I will now switch to a little side quest, not by Peter. Hi, Peter.
I'm here at OEC headquarters in Paris talking with Dr. Marbide, author of The Venturesome Economy. Dr. Bide, what are some of the common misconceptions about innovation?
People frequently misconceive innovation as an activity undertaken exclusively by men and women in white coats. In fact, the kind of innovation that sustains widespread prosperity is undertaken by everybody, not just scientists and engineers. It's people who, people on the factory floor, people who sell and market new innovations, because new innovations can't be used unless they're sold and marketed. And most importantly, I'd say it's innovation by users of innovation, because the use of innovation is usually not a passive process. So this innovation involves everybody in the economy.
Dr. Bide, what's an appropriate role for government in fostering innovation?
Because of the misconception that innovation is undertaken principally by scientists and engineers, governments tend to focus their efforts in subsidizing science and technology. In fact, the most important way in which governments affect innovation is rather quite indirect. As an economy advances technologically, it requires governments to do more and more in a legitimate sense. So there are positive externalities that have to be supplied by governments. There are negative externalities that have to be controlled. So for instance, when the automobile was invented, you needed traffic police, you needed roads to be built, you needed safety controls. When radio was invented, you needed the allocation of spectrum. So there are a wide range of ways in which governments can advance or retard innovation, not necessarily by simply subsidizing R&D.
Dr. Bide.
Enough. Jan and Jan, can you tell me a little bit more about the role that innovation plays in Belgian policy and society? How is it being perceived?
Innovation is going to save us after Corona. It was very important, and it will be more important for the future. And referring to the video we just saw, we can say that innovation is everywhere. And as a society and as a government is trying to enhance innovation. So basically we are talking about two separate ways. Today we are basically talking about the patent box tax exemption, but you have to know that besides that, and we've talked about the wages which are quite high and the personal income tax, which is even higher than that, the government has some tax exemptions on R&D for employees who are working in whatever kind of an industry which doesn't lead to a patent, but which can be new to a sector without having it patented. And this brings us to a quite strange situation under Belgian law. What is invention? And it might be something like Harry Potter, but we have a Ministry of Invention, and that's called BELSPO. And its function is to judge whether or not something is new. It's not something we are going to discuss. It's something with a company withholding tax in favor of the employees and the company, something in between. But be aware that innovation is more broad than just the patent box, which we are mainly going to discuss during this session. Another thing you should know is that at certain points, and we were all amazed, at certain points, Belgium, we have taxes are quite high, but at certain points we can have a very attractive tax regime on innovations. Be aware, the Belgian government realizes more and more that the income of the corporate income tax is going down, and we are focusing. We are tax lawyers, and so we have the privilege to do tax litigation as well, besides the advice and guiding clients through rulings. We see that if it comes to tax litigation, there's not only the law, but also your story writing as a company should be right. Because what we experience in litigation is that the law might be very clear, but that the tax administration during tax audits doesn't agree with a lot of the exemptions. And the paperwork at that moment is extremely important. So that's something you should know. If it comes to a very good system under Belgian law, be aware that we have the Ministry of Innovation, BELSPO, and that there might be a tax auditor who doesn't always agree with what is being considered as innovation. But without any doubt, when you have a patent, that's quite clear. But now, also besides a patent, you have innovation, and there's some discussion going on.
Okay.
Jan, do you want to add something on?
No, I think that was quite clear.
Then I ask Peter how we can see this happening here in the Netherlands.
Well, thank you, Bas. Yeah, so you first asked what how innovation is looked at in the Netherlands from a societal and other angle, and it's actually quite important to the Dutch society. Innovation is, as Mona Keizer, our currently not really in office, demissionaire, we say in the Netherlands, Deputy Minister of Economic Affairs. She has set the goal, and she has voiced the government's opinion that the Netherlands is in the top 5 of the world's most attractive countries for R&D and innovation startups. So that says a huge deal about where the Netherlands wants to go with innovative businesses. Also, when we're talking about tax, tax plays, of course, a big role, especially for us tax advisors, but also it plays a big role for innovative startups and other businesses, because we have, as you said, in the cost phase and in the profit phase, there are certain rules, certain measures that we can use to first reduce the costs, for example, to reduce the wage costs that you have to spend to have your employees remunerated. But also in the profit phase, you can lower your corporate taxes to a very, very minimal level, so that also in the profit phase, you get way more cash, and therefore it boosts your valuation, which further makes you attractive for investors. So there's a lot of activity around innovation in the Netherlands, and it's really on the government's agenda right now.
Right. So basically, we see an overlap here that, let's say, innovative firms are looked upon to resolve the issues of our time. Successful startups are the heroes of today. And how do we make it work? Well, you guys already got a little bit technical, so let's give in to temptation and deep dive, because we're having a tax webinar anyway. So first, to set the scene, we, the guys at Tuerlinckx and ourselves, actually did a comparative studies, and to do that, we used a base case. We were looking at a company we call MedTech, because it's a creative name, and these folks are making something new. It's a shampoo to help you with everything. And there's 2 investors. One of them is local, and the other one is from the USA, and we are doing a mix of equity and loans. There's going to be a holding entity and an operational entity, which is going to do R&D and production and sales. So basically, the shampoo is being developed, then it's being made, and it's being sold from a single location. So we're not doing anything complicated yet with transfer pricing. Now, if we zoom in on the financing cycle in our case, there's a few elements that we see. We're highly simplifying. So basically, if I peel off this visual, first of all, we can see that we have R&D cost, which, well, increase and increase until we have a finished product. And then basically we stop. We're saying this is finished and we're going to launch a new product. We shift focus to something else. But this specific shampoo is being developed for 10 years, and every year the production costs increase a little bit more than inflation does. So that is this line. Now, apart from the research cost, we have the corporate costs, such as those for maintaining the company, but also for production. So we basically see when development is over, production takes over, and resources get more accessible and specialization increases. So our corporate costs reduce, and these are combined are our total cost. Especially in the beginning, we can see the valley of death occurring there. There's big expenditures and there's no income yet. Then if we look one further, we can see turnover. At the beginning, there's no sales yet. So on a product or scale or startup level, the first decade, there's no sales. So logically, that's a loss-making phase. It's cash flow negative. And it's also on an accounting, from an accounting perspective, it's a loss incurring phase. And after 10 years, we have the big boom. We have big commercials in the train stations and in the supermarkets, and we're placing the product and it's selling, and it's doing so increasingly until after about 17 or 18 years, it's no longer new and people lose interest. Then if we accumulate these, we can see what the cash flow is on a product. Add the cash flows together, we can first see that there is a cost phase and a profitable phase. So the first decade, the shampoo is a loss-making proposition. After a decade, it becomes profitable. And then if we go down one further and we add everything together, we can see what the cumulative results are. So the first 10 years, it's adding in losses. And then the 10 years after that, we start making good on those. And after about 19 years, we actually drop through a cumulative profitable phase. And that is when the real returns take place. So this is a patient product. Maybe for a shampoo, it's not super realistic. But for instance, in life sciences or drug development, 10 to 20 year cycles can definitely occur. Reason we took this long cycle is because it makes a difference when you look at the loss absorption rules. Putting it all together, we also put a cash needed in there with the fictitious case that first there was a seed round where the friends, families, and fools of our shampoo startup invested. We had a Series A where we got some private investors on board. We went into a sales phase where basically we started becoming a cash flow positive firm. So we no longer needed extra funding. And at some point we are exiting the business or the product. And that's when we have a big boom. But if we look at the cash, at the cumulative cash, then after about 20 years, you're doing good. So if we tie it all together, this is what it looks like. We will zoom in on some product angles here, because the real question is, how can tax help? And before we answer that, maybe Peter, who is our valuation expert, can say a few words about the impact that cash has in any discounted cash flow valuation, which today is the dominant valuation method when looking at products or especially companies in an exit situation. Peter, take it to the bridge.
Okay, so I'm quite sure everybody has a basic concept or idea of what this entails, though in current corporate finance theory and also in practice, the enterprise discounted cash flow method is the preferred method to value businesses. And that it is a method that projects the cash flows that you're expecting to have in coming years, and collapsing it in a single number, in a single digit, or not in a single digit, but in a single number, to express the value at a certain point in time of all future cash flows. So what does that mean? It means that we first look at all the operational revenue, operational costs, operational profit, and operational taxes. So that means the tax on the operational profit. After that, there is a resulting cash flow. It's an operational cash flow. It's a free cash flow. And then we project it to many years in future, preferably 15. And then after that, there's too much vagueness surrounding the whole projection because it gets too far away. It's too hard to predict. So then we use the terminal value. But the cash flows resulting from the sort of the calculation I just mentioned, they get discounted by a certain factor. So that means that, and now I have to say it correctly because this is always tricky theory, and also we get a lot of discussions with tax authorities for it. But there's a lot of importance in what costs you deduct to get at the free cash flows and which costs you don't. So, for example, all the Dutch measures that I just mentioned, so the R&D wage tax credit, not really a wage tax credit, but it reduces the total wage cost for a company, and also the reduction in profit taxes, that those two are really part of the operational taxes, so the tax on the operational profit. And therefore, those reductions of those costs, they will mean higher cash flows, which means that the base that is discounted is higher. And it also means that the terminal value that is used, and which is often a big part of your valuation, is also increased. So that way, company valuation is yeah, the business's valuation is way more attractive for investors as there's much more cash flow generated.
Fair enough. So how can tax help? It is basically the biggest difference between EBITDA and free cash flows. And if you can reduce your corporate income tax rate, as well as reducing your cost, basically you're increasing shareholder value. And that's still, even though it's being discussed recently, still a very important metric to see how you can access capital. So then let's see, what exactly have we thought out? Basically, we look at the basic systematics first. Belgium and the Netherlands don't differ much from one another. We have a very similar corporate income tax base. Of course, if we zoom in deeply, there's lots of differences. But basically, we levy a maximum 25% tax on corporate profits. Dividends are non-deductible, interest payments are, and we pay our employees a wage upon which we have a maximum withholding of 49.5% in the Netherlands and 50% in Belgium. So basically, the basic systematics are very similar, and that means that any difference would really have to be made by special regimes. So then let's zoom in on our brethren, Belgium and the Netherlands. What have we put on the table? First, we are zooming in on the cost phase. When you are making these costs in the cost phase, your R&D department is running and you're not making sales or enough sales yet to cover the costs. So you are burning through cash. What can we do to reduce the burn rate? Well, first of all, we can be quite short about R&D tax loss credits because neither of us have special regimes for losses incurred by the R&D departments. But maybe it's fun to zoom in on the special innovation related depreciation rules, of which Belgium has a regime. Tuerlinckx, can you fill us in? What can a Belgian
can you guide us
do?
through very
Yes,
briefly?
of course. For certain kinds of patents and eco-friendly research and development, you can use a depreciation period which is much shorter than the normal or standard depreciation period. For example, a specific patent as being part of IP should normally be depreciated in 5 years. However, in R&D cases, we decrease this period to 3 years. That's basically the system.
Sounds attractive. What is the feedback that you're getting from clients on these systematics? Do they find it favorable?
It does depend on the phase in which you are in your maturity. Early on, if you're accumulated losses, that doesn't matter so much. Once you're in a profitable phase, companies really enjoy it, and this is really boosting investments. And yes, companies enjoy it very much.
Regime debatable, or is it safe?
That's quite safe. That's quite safe. It's not. We've seen not a lot of accidents litigation-wise with regard to that.
Okay. Thanks very much. So we don't have a regime like that. It sounds like something that we could reintroduce. Something we have is over here is a subsidy on the wage cost of your R&D department. So if we kind of zoom in on what your cost structure looks like, then I guess your R&D department will consume a lot of your cost. And something that happens in the Netherlands is that you can find a subsidy on the wage cost of your R&D department. It is called WBSO, which is a Dutch acronym for the Act for the Advancement of Research and Development. And it is a subsidy that means to ensure that there's R&D work being performed in the Netherlands. So basically, we find that the type of employment we want Dutchmen to find. And the WBSO subsidy basically allows you to deduct. The subsidy is granted by allowing you an hour's budget. So you file a request with the Dutch Enterprise Agency for an R&D project, then the project gets an hours budget, and the amount of hours you can multiply by an agreed on hourly rate, and the wage tax that would be due on those hours you can deduct from the actual wage tax due. So it's a little bit of a difficult systematics, but basically what this means is that there's no cash flow thing going on with the government. Every month you file a wage tax return, and in that same wage tax return you have gross wage, and then you see what the wage tax due is, and from that wage tax due, which is an actual physical payment that takes place at the end of the month, you can deduct the WBSO budget basically granted for that month. So that means it reduces burn rate, and it helps when you're in the cost incurring R&D phase. We get good feedback from clients on this, especially when you are very early stage and revenues are far away. Wage costs in any service or R&D economy are usually by far greatest, except if you're in a very capital intensive business. So on the cash flow basis, wages are very significant, and any reduction of the wage cost on it, which is generally about 50% given the income tax rate, are very welcome. So this regime is actually,
Maybe if I can just chip in, I mean, this can reduce the burn rate, this can reduce the total wage cost that you have to spend, but it also can allow a business to pay better salaries to its employees, right? Maintaining the same level of wage cost, but just another mix of taxes.
Very, very fair point. Yeah, true.
Bas, we have something similar, Jan?
Yeah. Basically the same system. So the employer pays the wages and they have the company withholding tax. But in certain cases, under certain conditions, for example, your employee needs to have the degree from a recognized university or hogeschool, which is rather Belgian, among others. The same, they have to, in principle, keep part of the wages paid as withholding tax, and then in the normal situation, the employer has to pay the wages as a tax to the government. However, for research and development, there's I wouldn't rather say it's a tax because of the way it works. It's more of a subsidy because there's an exemption in the obligation for the employer to pay the withholded tax to the government. So they can actually, when the conditions are met, they can actually keep part of the wage costs in their own pocket, which otherwise they would have to pay to the state.
Mm-hmm. And there, as a litigation lawyer, we should say there we have a lot of discussions with the tax administration, basically on the burden of proof. What are the hours? What is the qualification? What are you working on?
And even on what is research and what is not, even though that's strictly up to the Ministry of Innovation we mentioned earlier.
What kind of research would you generally say qualifies? Because if we look at the professor who we just saw speak, are we looking at white lab coats, or are we looking at any type of development?
I would not say any type of development. It has to be new, but it's not that strict as being new under the patent law. Under the patent law, it has to be absolutely new for the reason of the company tax or the wages withholding tax. It has to be new in a sector. It has not to be qualified as a patent, but it has to be more new in a general environment. And that's specifically the reason why the tax administration at a certain moment in time said, listen, we are not here to judge that. We are not scientists, we cannot judge that. And at that moment, we decided to invent or to create BELSPO, which is the minister who makes a judgment or whether something is innovative enough to support. And there we see that the tax administration doesn't agree with BELSPO, although BELSPO was created not to support the tax administration. And this is, frankly speaking, this is a very, very, very sad story. and this might put Belgium down on the innovation once this is becoming clear to the world that we're giving something on one hand and taking it back on the other hand.
Well, that's a tale as old as time when you have two different government agencies and one has its DNA to collect and the other has to subsidize. There's going to be tension. So there's something quite similar happening here with our WBSO. I've got a little one pager here and it's maybe a lot of words, but basically the way it works is first you go to the Dutch Enterprise Agency where actually engineers work. And they are to judge whether what you are doing is new. And when we talk about new, it means new for the company itself. So you don't have to have a new invention that would be patentable. It means that you are doing technical work that leads to something that is new for the company. Examples, what would work? Programming new software. What does not work? Creating a dashboard that ties together different pieces of existing software. What would work? Developing a new patent. What would not work? Finding new ways of marketing your new patent or drug. So basically, we look at innovation, and it doesn't have to be white lab coat work. It can be software development. It can be all sorts of innovation, as long as what you're creating is new for the company and has a risk of failure. That is subsidizable under the WBSO legislation or the R&D Advancement Act. But yeah, same thing, different agency and a discount on the tax owed to the tax authorities.
Again, let me chip in what our Belgian colleagues just said about the subsidy being actually not granted to the company, but rather you get a discount on the wage tax costs you have to withhold and pay to the tax authorities in Belgium. It is exactly the same in the Netherlands. It is a subsidy, but it is granted by providing a discount on the withholdable wage tax. So it's similar, or it's actually exactly the same actually.
Yeah, so WBSO apparently a universal thing. If we look back, I think we have the cost phase incentives down. So there's one thing I'm missing here, significant one in the Netherlands. There is, and it really took a flight during COVID, but the Dutch government can also back some loans to small businesses. So funny thing is that on the ease of doing business index, the Netherlands does quite well in most categories. Infrastructure is good. Education is good. The ease of paying taxes is good. What's not so good is the access to capital. And in order to increase that, the Dutch government, which has a AAA rating, can sometimes offer can back up a loan granted by a bank. So it offers the guarantee to the bank when the loan is extended to an innovative company in the startup phase. That is something that has worked quite well during COVID. Actually, we used it ourselves to refinance some old and very expensive loans, and it's a good measure. It's a good measure. It seems successful, and also by leaving the choice to the bank whether to finance or not, there's limited state aid risk because the measuring the case still takes place in a private context. That also means that the interest rate that you can expect on a bank loan, if it's backed by the government, reduces drastically. So that also reduces burn rate, and makes for a better proposition in the R&D phase. Let's zoom into the profit phase because that's where the other interesting stuff happens. What are you Belgians doing there? When I first noticed this seemed something crazy. I'm going to zoom in on the slide here first. Basically, the two main elements that become important when you start making profits is how fast can you offset losses that you made in previous years against profits of this year. So if you start making profits, imagine you have 2 million in profits and there's a 25 corporate income tax rate. You would generally have to pay 500K in tax, but if you still have over 2 million of losses, and you can offset them at once, then in the new profit year itself, you pay no tax. So what we see here is you guys have fast loss carry forward facilities, and you also have a very generous patent box. Now, a patent or innovation box, maybe just to set the scene there a little bit, basically means a special rate regime where you can allocate part of profits that are related to your R&D in order for that portion of profits to be taxed at a lower rate. And there's different systematics at making this work. It is all meant to enhance investment in R&D that is risky R&D, because if it works, then later free cash flows are higher because the tax factor is lower. But Belgium, please fill me in. What is happening there?
We and Jan will provide you with the details, but we don't consider this a high-speed system, because we are coming from a phase where losses, the carry forward was without any limit. Within a few years ago, we introduced the limitations. Jan, can you very briefly go through the details of the limitation on losses carry forward?
Yes, there's no limitation in means of time. You can indefinitely carry forward losses from previous years. However, there is a limitation. Well, let me rephrase that actually. There is a minimum tax base from 1 million euros and up. There are several deductions, one of which is the innovation deduction. And the new rules is, I think it was implemented in 2019, says that those deductions taken together can only, you can only deduct 70% of the profit above 1 million. So for every euro above 1 million.
So to the threshold of 1 million, it's totally tax exempt. And above, only 70% is exempt due to the carry forward of your losses.
Right. So then our systematics are exactly the same. We came from, first we had indefinite carry forward, then we went to a phase where we had 9 years carry forward, and then losses evaporated. That reduced to 6, which is scandalous and very unattractive for life science R&D. Then we now went back since this year to indefinite carry forward, but only up to 50% of profits in excess of 1 million euros in any year. So you guys are 20 percentage point quicker, but that's 40% relatively quicker. So, relatively speaking, we're still pretty high paced. So good lobbying there, guys. Well done. And can we look at your patent box? Because that, I believe, is a very interesting systematic.
Our patent box, so first of all, it's not for all inventions. It has to be patented. But once you have an invention which can be patented, we have our patent box. And there we have a tax exemption on 25%, 85%, so being understood that only 15% is being taxed of your profits coming out of your patent. Of course, and as almost everybody on the scene here will understand, it's not the profit you're making with the patent, but it is the profit allocated to the patent, and it's more broad than just only the.
So are we? How is arm's length working there? Do we look at? Yeah.
You should benchmark, and basically there's no way around it. You should have an advanced ruling on the benchmark of this one. Generally, our experience between 8 and 13% of your total profit can be tax exempt. That's something which is an average, and it's not only the 85% which is tax exempt. It's not all the inventions and all the costs. You need to determine what's your nexus. And what is your nexus? Jan, can you explain very briefly what the nexus is in that equation?
We basically stole this from the OECD. So the nexus is a fraction within not the denominator, but the upper number. I'm sorry, I forgot the English word.
The total invention costs?
The total invention costs multiplied by a bit of an arbitrary factor of 1.3 and then divided I'm sorry. On top are the qualifying expenses. So the expenses you make in the framework of R&D multiplied by this 130% and then divided by the total expenses.
And you will ask the question, what qualifies as qualifying? This is your own expenses. We don't like the agree of cooperating with other companies. Those expenses will be excluded from the qualified costs, which can be used into that equation.
So then if we look at our systematics, that's very much the same. So I guess that the OECD is succeeding in uniformizing this somewhat. So we have a innovation box. So that means you don't necessarily need to get a patent. What the innovation box is first you have to get an R&D project granted, which basically goes back to the WBSO subsidy we just discussed. And that's a binary thing. You've either got a R&D project granted or not. Now, if we look at the innovation box, then we say the percentage of profits, total profits, that allocates to your R&D function can be placed within the innovation box. And there's different ways of determining what percentage that is. We have the per law definition, which is exactly the same formula you have got going on. The qualifying cost multiplied by 1.3 divided by total cost, and that factor multiplied with total profits is the amount that you can place within the innovation box, where external consultants or contract researchers, they also qualify as qualifying costs. But we also have what we call the peeling off method, and that is something when R&D is central to your business. You can agree on a tax ruling with the tax authorities, and they come by your premises and they look at how does your business work. And logically speaking, what percentage of your profits are caused by your self-produced IP, by your know-how, by your innovation. For instance, you can look at 30, 40 to 50%. Other profits are incurred by, for instance, corporate excellence, marketing, general know-how. But let's say 40% or 50% can be allocated to the innovation box. If it's 50%, then 50% of your corporate income tax is taxed at 9%. And the other 50% of your corporate income is taxed at the regular 25% rate. So that goes for an aggregate of 17%, which is a 8 percentage point discount, but relatively speaking, about a 40% discount. So that generally really increases free cash flows.
Oh, it does, Bas. And just to add to that, the effective tax rate on the, as Bas already told in the beginning of this webinar, there are two brackets in the Netherlands in the profit tax and the corporate income tax. The first 245,000 euros are taxed at 15%, and the excess is taxed at 25%. So the innovation box, after determining what part of the total profit is allocated to that box, is then taken into account for 9/25 of thereof. So it means that if you only have profits in the lower bracket, then your effective tax rate is even lower. In fact, it's 5.4%.
So then there is a issue, and I was wondering what your opinion is on this, because if we look at the effective tax rates on your innovative profits, then one thing comes to mind. And please bear with me because I've got a fun little snippet again. Right here.
At last, on a sunny day in London, a breakthrough. After years of negotiation, a deal to prevent the world's tech giants from avoiding billions of dollars of taxes. A deal many people thought would simply never happen.
It's a very proud moment. Whether it's people operating in tax havens or it's digital companies, we're going to level the playing field and inject that principle of fairness into our global tax system.
The details are complex, but the deal G7 finance ministers have agreed comes down to two key reforms. A global minimum corporate tax rate of 15% to prevent companies like Google, Facebook and Apple shifting profits to low tax jurisdictions, and new rules to calculate what they owe and where. While it could involve billions more pounds of revenues, it's still unclear whether those rules, for instance, would apply to Amazon. Now, this might have happened in the UK, but
15% global minimum corporate income tax rate. And the question is, would a patent or innovation box mean you qualify as a synthetic tax haven that needs to be withheld upon if you receive royalties? Or does it mean that your regime is not in line with the Pillar 1 and Pillar 2 approach? What can we do? What are your opinions there? Oh, guys, sound.
We hope this is not going to happen and that the incentive will remain and that this is not going to be considered as a carve-out. This should stay in place, definitely.
Yeah, so the way I see it is there's caveats going on, but if I look at the OECD reports, those are mixed. If I look at the economic reports, then I see that the OECD has a preference for, well, let's say input side subsidy regimes because they're more targeted, such as the WBSO we have, and very similar to your wage tax regime going on, and maybe even the faster amortization regime. But yeah, I guess there's going to be pressure on patent boxes and innovation boxes. That'll be something, well, very good to keep in mind because I actually don't mind them. I find that nexus-based tax incentives with legitimate aim. But yeah, we'll have to see what the OECD does, especially for the Netherlands and Belgium as high IP producing but low manufacturing smaller countries. Then we have, if we tie it all together, I did this in our Dutch upright version, which is our real study. And what I concluded was that during the cost phase, the Dutch regime is a little bit better. It actually reduces burn rate more. But at the same time, during the profit phase, you capitalistic Belgians, you are actually putting a better regime in place. It seems that your patent box is more generous and your loss settlement regime is quicker. So I actually believe that for profitable businesses, Belgium is a good place to go. And for, well, businesses still in the development phase, the Netherlands might be a better place to go. All other things being equal. What are your thoughts?
Yes, we're very near to each other. There might be some differences. The main difference is, and I don't know which one I would prefer, that we have a patent box exemption, you have an invention exemption. Personally, I would rather take the second because the invention is far more broader and can be used on a wider scale. You're totally true, our exemption, the 85% is quite high. But the taxable base on which it can be applied is definitely less. So does depend on your business, whether it's an invention, whether it's you can have the patent. I wouldn't say that one country, they're in balance. I wouldn't say that one is more favorable than another. One has to make the calculation and make a real study to really define where it's better to go. But in principle, I agree with your view, only I would prefer for Belgium to have the invention rather than the patent box.
Okay, well, noted and kind words. If we look at the treaty comparisons, I guess it's more or less the same with the usual suspects. I really had to search. If we look at the UK or the United States as an ultimate investment source, then our treaties are identical. It doesn't matter if there's FDI happening in Belgium or the Netherlands. Only Singapore, the Netherlands has a marginally better treaty, except for, well, interest payments. So you guys have a lower source withholding tax for interest payments as per the treaty. So then basically one thing remains. Are you guys doing anything special for foreign talented employees, generally not being EU citizens?
Not very specific. We have the expat stelsel, we have the wage exemption, which we discussed. But besides that, we don't have a real system to encourage people to come to Belgium and make some progress here.
Okay, so we have some systematics in place here where we are saying, well, what we call desirable migration to really facilitate that. We have some special expeditious visa regimes. We even got a pilot going on now that if you go and work for a innovative startup, which is a company less than 3 years old with an R&D subsidy granted, then you can hit the fast lane for visa applications if you're from outside of the European Union. And anyone moving to the Netherlands from more than 150 kilometers from the border away that has a specific skill, which is evidenced by a minimum wage of grossly 46K in a year, can apply for the 30% ruling, which gives you a 5-year exemption from income tax on 30% of your wage, and also exempts you from wealth tax and shares tax. And that is really perceived as being quite attractive. I was recently interviewed in the context of football, whether that made a big difference for the Dutch teams. I know it doesn't, because we usually lose to the Belgians. But the Italian regime, for instance, has a 50% exemption, and the French regime has a 30% exemption as well. So apparently it's a common theme. But yeah, Dutch knowledge migrants, as we call them, really find that a favorable regime. So yeah, tying it together, many things alike. Again, some different takes. Very interesting to learn more about. Mostly your patent box was, for me, was the biggest takeaway. What are any?
My general impression is that the Dutch government is more supportive. It might be that on some areas we are scoring better, but in general, I believe that the Dutch government is more serving. You're more being considered as a client and not as a taxpayer. That might be one of the biggest differences we have.
Yeah, so I can't speak for many experiences with Belgium, but I do know that we have, we are very adamant at the moment on rolling out the orange carpet. We have enterprise agencies and investment agencies abroad doing a great job scouting businesses to come here. Also, there's really a new atmosphere that, startup founders are the new heroes. And the Netherlands has long been a little bit anti-corporatist. So, they like to pick the side of the little guy, especially if there's something green or medically innovative going on. I guess the atmosphere is really there for start and scale up business to sprout. We just need to speculate, will we ever get a new cabinet? Because we had elections and we're still waiting for new government, guys.
We've been more than 500 days without a cabinet, and we've never done better than during that period, isn't it, Jan?
So there's lessons to be learned there. Hey, so if there's no Q&A, then I guess we have it's a wrap. And that's the quick 101, 1 hour show on the Dutch and Belgian incentives. Peter, thank you for your economic insights, and great look there on the bar stool.
Thanks, boss.
Which we could have framed better, but you're in a spotlight, so you took it. Jan and Seppe behind the screens, thanks very much for your insightful collaboration.
Our pleasure.
Let's hope that we can leverage the best of both regimes soon on a client doing business who doesn't want to choose and says, I'll have it both ways.
Yes, definitely.
Thanks all the viewers for watching, for your patience. Anyone who watches the rerun, we appreciate your interest. Feel free to contact us. Tuerlinckx and Archipel signing off.